Financial statement analysis. There are three different financial statements: balance sheet, income statement, and cash flow statement. In the balance sheet, it is a snapshot of the firm. We want to look at or summarize what a firm owes. We call those assets. What a firm owes, we call those liabilities, and the difference between the two are the equities. And usually we see assets first. They might be on the left-hand side or on the top, followed by liabilities and the equities. It's called balance sheet because the assets must equal liabilities plus equities. In other words, left-hand side must equal the right-hand side. The total number must be the same, so that it's called balance sheet. And this balance sheet is at a point of time. We take a look at the company. That's why in the beginning we said this is a snapshot of the firm. Here are more details about the assets. Usually we see current assets first, followed by fixed assets. Current assets are assets that have life less than 1 year. Less than 1 year, they will be turned into cash. And usually we see cash, accounts receivables, and inventories. The most liquid assets are listed first. So usually it's the cash on the top, followed by accounts receivable, followed by inventory. These are current assets. After that, we have fixed assets. These are assets that will last longer than a year. There could be tangible fixed assets, such as a truck, a computer, a building, anything that we can see. There are also intangible assets, such as trademark, patents. These are still assets, and they last more than a year, so they are in the fixed assets. We just couldn't see them, so it's intangible, but they are still fixed assets. Usually the asset structure reflects a firm's line of business and managerial decisions. So depending on what the company does, the line of business, we see different combinations of the assets. Also, how much current, how much fixed assets to carry, that's a managerial decision. So it depends on the management. They make such decision on what assets to carry. Then we have liabilities. Similar to assets, current liabilities are listed first. They have life less than a year, such as accounts payable, notes payable, short-term liabilities. We expect to pay them within 1 year. Following current liabilities is the long-term debt. They will be due in more than a year, so it's a long term. And similarly, liabilities also reflect managerial decisions. How much current liability to carry, how much long-term debt to have. These are decisions made by the management. The difference between assets and liabilities are the equities. So we said that balance sheet has to be balanced. Assets always equal liabilities plus equities. And among the items, we have a very important measurement to look at that is called the net working capital. Net working capital is a short-term measurement. It's the current assets minus current liabilities. Current assets, we expect to turn them into cash within a year. Current liabilities, we expect to pay them within the year. So for healthy firm, we want to have enough money, cash, to pay our bills. So we expect the net working capital to be at least higher than 0. So for a healthy firm, net working capital should be positive. If it's not, we might run out of cash. Then we have to do something to avoid the liquidity issue. Here is an example of the balance sheet, and this is Walmart. We have the past 3 years from 2019 to 2021. And the data are generated from the SEC government website. So first we see assets, current assets first, including cash, receivables, and inventory. Followed by the fixed assets, we see properties and equipment, and then other intangible fixed assets. Next, we have the liabilities. We have current liabilities, short term, and then followed by the long-term liability, long-term debt. The last component is the equity. We have common stock, capital in assets, retained earnings, and other items. We said balance sheet. The most important thing is they have to be balanced. So let's double check the total liabilities and equities at the end, 252,496. Let's go back. At the end, it's also 252,496. So that's the total assets must equal total liabilities and equities. If not, something is wrong. That's not right. That's why it's called the balance sheet. Next, we have the income statement. We said balance sheet is a snapshot of the firm. At a time, we look at the firm. Income statement is different. It covers a period of time. Over a period of time, how much revenues we generated. So it usually starts with revenues or the sales, the same thing, and then followed by the costs, by the expenses, by the taxes, all those things we have to pay. The bottom line is the net income that we generate. So the general concept is the revenues or the sales minus all the costs and expenses to get the income. But of course, there are a lot of items in between. The general form of the income statement, we see revenues minus costs minus depreciation. We get the earnings before interests and taxes. We call that EBIT. EBIT minus the interest expenses, we get earnings before taxes. Earnings before taxes minus taxes, we get net income. So we start with revenues, we end up with net income. But this is only the general form. Different companies, we might see different items. There are some important items that we need to pay attention to. The first one is earnings per share. In order to compare companies, we use the net income divided by total shares outstanding. We get the earnings per share. That is like the earnings the company generates for each shareholder. After we convert the earnings into the per share basis, we can compare firms in different sizes. So that's the earnings per share, EPS. At the end of the income statement, we have the net income. Net income goes to two places. Companies can either pay out as cash dividends to its shareholders or keeps the money in the firm for reinvestment. That is what we call the additions to retained earnings. And that is the one item we see on the equities, on the balance sheet. So they keep the money in the company, it goes to the equity on the balance sheet. But that's after they pay the dividends. So the additions to retained earnings can be computed as the net income minus the dividends. And we want to keep in mind that figures in the income statement do not represent actual cash flow. It's just an accounting figure. Because we use the accrual accounting to recognize sales, to recognize costs, that doesn't mean the actual cash we receive or we pay. In addition, there is the depreciation that we take every year. That is not the actual cash flow we pay. It's just a way to spread out the capital investment into many years. Because of these reasons, net income is not the real cash flow the company generates at the end. So we need to keep that in mind. Here is an example of the income statement. It's also on the Walmart for the past 3 years. The amounts are in millions. So we see the revenues, total revenues. We see the costs. We see the expenses. And then we have something called the operating income. That's the EBIT we mentioned earlier. And then we need to pay interests, and then we will get the income before taxes. Minus taxes, at the end, we get the net income. That's for the past 3 years. We mentioned that the figures on the income statement are not the actual cash flow. But cash flow is important. That's why we have the cash flow statement. We will not focus too much on the cash flow statement in this class, but we still want to know the basic concepts. On the cash flow statement, there are 3 activities. They are the operating activities, investing activities, and financing activities. For the cash that we pay or the cash that we receive, they will go into one of these 3 activities. For the operating, we see current assets and current liabilities. All these accounts, the change will affect the cash flow in the operating activity. For the capital expenditure, like we purchase fixed assets, they are the investing activities. We pay dividends, we borrow new debt, or we issue new shares, or even we buy back shares. Those are involved with cash that we pay or cash that we receive, and they are the financing activities with the dividends or the debt. So in the cash flow statement, here is the example. I apologize, the words are very small, but that's the best I can do. That's the cash flow statement for Walmart from SEC website. And I just want to show you that the 3 activities we see, operating, and then investing, and then the financing. So operating, we see the depreciation, we see the current asset, current liabilities items. The investing, we see the equipment purchase and other things. For the financing, we see the short-term borrowing, the long-term debt, dividends we pay, buyback stocks, things like that. So that's the cash flow statement. Financial statement information is very useful. We can use that for internal, such as the performance measure, the division comparison, or planning for the future. We can use that for outsider, for potential creditors and investors, bond investors or stock investors, or credit rating agencies. They come in to rate the company, or even in the mergers and acquisitions, they try to evaluate a company as the acquiring target. They need to look at their financial information. But the most important thing is about comparison. We can compare the financial statement in the past over several years to identify a trend. Either it's going up, going down. That's called the time trend analysis. That is the historical comparison. or we can compare among the peer. We call that the peer group analysis. That's it.